Welcome to the deep dive. We've got quite a stack of source material you sent over on, well, one of the more complex stories in telecom right now.
Lumen Technologies.
Exactly. We're cracking open their Q3 2025 results, the SEC filings from October 30th. It's a lot.
It really is.
Our mission today is clarity, really. Lumen's undergoing this radical, almost painful surgery, selling off huge assets, shedding debt.
While trying to pivot hard towards this high-value future, the whole AI economy thing.
Right. And that tension, that balancing act between the cleanup and the growth push, that's what we need to understand.
And you see it immediately, don't you? Right from the
Yeah.
earnings report headlines.
You do. The GAAP number jumps out first, a net loss of $621 million for the quarter.
Which is just massive, a staggering loss.
But then, literally in the same breath, you read the CEO commentary. Kate Johnson calls the results strong.
Exceeded expectations on revenue, adjusted EBITDA, free cash flow.
So how does that work?
Yeah.
A $621 million loss alongside strong results. It sounds like spin, unless you dig deeper.
It does sound like it, but it's not really spin. It's more about translating that corporate accounting language. You have to look past the GAAP net loss.
Generally accepted accounting principles.
Right, because that $621 million, it's basically, you could say, the funeral bill for the old company. It's loaded with huge non-cash charges, one-time special items from all this restructuring.
So the strong results refer to something else.
Exactly. Management's talking about the operational performance, the cash generation. That's where non-GAAP metrics like adjusted EBITDA and free cash flow come in.
They strip out those historical costs.
They strip out those big non-cash items. Yeah. Special items, too. It gives you a much clearer picture of the actual money flowing into the business today.
Okay, put that free cash flow number into perspective for us then.
Sure. The sources show free cash flow, excluding those special items, hit $1.661 billion in Q3 2025.
$1.66 billion. And compared to before.
That's the key. Just a year ago, Q3 2024, it was $1.198 billion.
So a big jump. Nearly $500 million more in cash flow year over year.
Precisely. That surge in cash generation, that's why management feels confident. It shows the core operations are generating significant cash despite all the financial cleanup.
So the GAAP losses are the cost of the past.
And the free cash flow is the fuel for the future. That's the narrative.
Okay, let's unpack that operational fuel. Because this is really a tale of two businesses under one roof, isn't it?
Absolutely. A shrinking legacy and a growing future.
Let's look at the top line. Total consolidated revenue, Q3 2025, was $3.087 billion.
Still a decent chunk of change.
But it was down 4.2% year over year. That tells you the drag from the old business is still winning overall.
It is, for now. The decline outweighs the growth currently.
So where is the growth? And what's dragging it down so much?
This lines up perfectly with their strategic model, the grow, nurture, and harvest framework they talk about.
Right, separating the segments.
It's designed to show exactly this split. The future is the grow category. That's where the investment and energy are going.
And are we seeing results there?
We are. Early days, but yes. Revenue and grow product category was up a solid 8% year over year in Q3.
8% growth in this environment for telcos, that's pretty significant.
It is meaningful, yeah. Especially when the rest is shrinking.
What specific services are driving that 8%?
You can see the investment focus pretty clearly. Revenue from dark fiber and conduit, that increased by $49 million.
Okay, hard infrastructure.
Exactly. And IP services grew by $20 million. These are the building blocks for huge capacity needs.
Which ties into their big narrative.
The backbone of the AI economy. That's the strategic push. Dark fiber, high-capacity IP, that's what AI workloads need.
Okay, that's the narrative. But is it just marketing hype? What proof is there of actual deals?
Well, the proof is in the contracts.
Yeah.
Specifically for their private connectivity fabric, or PCF.
PCF.
The sources flagged a really enormous win. In October 2025, just after the quarter closed, they signed an additional $1 billion in new PCF deals.
$1 billion,
Yeah.
on top of what they already had.
Yep. That single announcement pushed their total cumulative PCF deal value over $10 billion.
$10 billion in committed deals. For a company with about $3 billion in quarterly revenue, that's huge.
It really reframes their potential, doesn't it?
Wow.
PCF is basically custom-built, high-capacity, low-latency fiber infrastructure for big enterprise clients.
Think cloud providers, large tech companies.
Exactly, the ones driving the AI boom. They need massive, reliable data pipelines. Lumen's positioning its fiber network as that essential middle layer. Secure, dedicated, high-performance connectivity. That $10 billion deal value is the market saying, okay, we need this.
That sounds like a strong future then.
Right.
We still have that overall 4.2% revenue decline to account for.
Right. If grow is up 8%, the other parts must be shrinking even faster to pull the average down.
So nurture and harvest.
They are, and it's by design. This is the managed decline part of the strategy. Nurture products, think traditional VPN, Ethernet, they fell steeply, down 16% year over year.
16%. That's a big hole to fill with 8% growth elsewhere.
It's the core challenge, backfilling that decline.
And harvest. What's in there?
That's the really old school stuff. Mostly copper-based services like time division, multiplexing voice, old private lines. That segment dropped 10%.
Okay. So they're milking those for cash while they shrink.
Essentially, yes.
Yeah.
Manage the decay, extract cash, but don't pour good money after bad trying to prop them up.
Well, let's pivot then to the other big piece, mass markets, the residential side.
Another area facing decline.
Revenue there was down 8% year over year. Mainly, the sources say, due to losing those copper-based customers. Other broadband revenue dropped $53 million.
The legacy drag again. Copper just can't compete.
However, within that decline, their own fiber build, Quantum Fiber, is telling a different story, isn't it?
It is. It shows that where they do invest in modern infrastructure, it works. Fiber broadband revenue was actually up a healthy 18%.
18% growth in fiber broadband, driven by the Quantum build-out.
Yeah, and look at the subscriber numbers. That's always the key metric. They hit 1.190 million fiber subs in Q3, up from 1.035 million a year prior. So they added over 150,000 net fiber customers in a year. When they build fiber, people sign up.
But, and this is the huge strategic move, even with that success, Lumen decided this whole unit is better off sold.
Sold for cash, yeah, to fund the enterprise pivot. The entire successful fiber build in those states is heading to AT&T.
For how much?
The deal is for $5.75 billion in cash. Pre-tax total, covers the mass markets FTTH business in 11 states, expected to close early 2026.
And the impact is already hit in the books, right?
Yeah.
Before the cash even arrives, what was that $628 million charge?
Ah, yes. That was a one-time non-cash goodwill impairment charge back in Q2, non-tax deductible too.
Explain goodwill impairment simply.
Okay, so goodwill is like the intangible value a company puts on a business unit, usually above its physical asset value. When they decided to sell mass markets, they had to reassess its value based on the sale price. And the $628 million charge basically means they realized the value they thought it had on their books was significantly higher than what AT&T was willing to pay. It's an accounting correction. Painful, but necessary.
Acknowledging the asset was overvalued pre-sale. Got it. Now the proceeds. $5.75 billion cash. Where's that going?
Primarily aggressive deleveraging. Paying down debt. The sources are specific. $4.8 billion is expected to go straight to paying down Lumen Technologies' super priority debt.
Super priority debt. That sounds important. What makes it super?
It means it's very senior debt. It sits right at the top of the repayment queue. Often carries higher interest, restrictor conditions. Paying that down first is key to reducing risk and satisfying the most demanding creditors.
Makes sense. So that's the immediate debt reduction. What about the longer-term benefits of selling this whole consumer division?
This is where the strategy really kicks in. Getting rid of this business is expected to cut their annual interest expense by about $300 million.
$300 million a year, permanently.
That's the expectation. A huge cash flow benefit. But maybe even more important strategically is the capital expenditure impact.
The CapEx.
Yeah. Selling this unit is projected to cut their mass markets fiber-related CapEx by about $1 billion annually.
Wow. $1 billion a year in capital spending just freed up.
Exactly. That billion was earmarked for building out a consumer fiber network they're now selling. Post-close, that capital can theoretically be aimed squarely at the enterprise grow products.
The higher margin stuff. The AI infrastructure build-out.
That's an entire premise. Reallocating those massive resources, that's the transformation engine.
Okay, this is where it gets really interesting. Shifting from operations to the big financial picture in 2025. Lumen's been sprinting to fix its balance sheet.
They absolutely have. A lot of heavy lifting this year on the debt side.
What kind of interest savings are they seeing from all that refinancing?
Year to date, through Q3, those transactions have already locked in $135 million in annual interest expense savings. They're chipping away at that debt cost.
And the total debt burden, where does that stand now?
Total long-term debt principal was $18.228 billion as of September 30th. Still a big number.
But the goal is to get that down significantly with the sale proceeds, right? What's the target leverage?
Yeah, the target post-AT&T sale is to get gross leverage below 3.8 times adjusted EBITDA. That's the pro forma goal, down from like 4.6x after previous sales.
Why is 3.8 times the magic number? What does that signify?
That leverage ratio is really important. It's often a threshold used by credit rating agencies. Getting below 3.8x helps distinguish between sort of higher risk debt and more moderate risk. It's crucial for confidence, borrowing costs, signaling stability.
Right, but as we saw with that huge net loss figure earlier, cleaning up debt, especially retiring expensive debt early, comes with a massive upfront cost.
It does. That's the necessary price of this financial engineering. And the scale is significant. Those debt extinguishment transactions, basically buying back or retiring high-interest notes before they mature, they resulted in a net loss of $666 million just for the first 9 months of 2025.
$666 million loss just on retiring debt early. That number really captures the cost of the transformation, doesn't it?
It's the purest example. It's the upfront fee they're paying to shed those old liabilities and secure that better leverage profile for the future.
Which explains again why the CEO can talk about strong cash flow while the GAAP number looks terrible.
Exactly. The loss is the receipt for the restructuring. The cash flow shows the current operational engine is still running strong.
Okay, turning to liquidity then, and the outlook for the rest of 2025. Yeah. Do they have enough cash to keep funding these investments and manage the transition?
They seem comfortable. Cash and cash equivalents were $2.4 billion at the end of Q3, a decent cushion.
Any other tailwinds?
There is one mention. They expect a $400 million tax refund sometime in 2025 related to recent tax legislation, they cite. That's certainly helping boost the free cash flow outlook for the year.
And based on all this, the operational performance, the financial moves, did they maintain their full-year guidance?
They did. They reiterated the 2025 outlook. Expect adjusted EBITDA near the high end of the $3.2 to $3.4 billion range.
And free cash flow.
Also reiterated, expected between $1.2 billion and $1.4 billion for the full year. So all signals suggest they're on track to meet the targets they laid out for this transformation phase.
Okay, so stepping back, if we summarize this for the listener, there are really two core realities here, right?
I think so.
One is that the strategic pivot focusing on grow and AI infrastructure, it seems to be working. You see it in the 8% growth. You see it in the $10 billion PCF deal value. Product demand is there.
Definitely signs of life in the new strategy. Measurable success, even if it's early.
That success story is currently buried under the immense multi-billion-dollar costs of dealing with the past, managing legacy decline, restructuring the balance sheet.
That's the perfect way to put it. That's the stock ticker shock right now. Lumen is investing heavily in the AI backbone future,
while paying these huge bills from the past. That $628 million goodwill hit, the $666 million loss on retiring debt early.
Exactly. Those numbers litter the financial statements. They represent the cost of shedding the old business.
So the real question for anyone watching Lumen is about timing, isn't it?
It's about velocity, yeah. Will the growth in those high-value grow products ramp up fast enough?
Fast enough to structurally outpace the ongoing planned decline of nurture and harvest.
It's fundamentally a race against that legacy decay. Can growth win before the old business shrinks too much?
A race that's now potentially turbocharged by that $1 billion capital shift we talked about.
That's the kicker, isn't it? That annual CapEx reduction from selling mass markets isn't just saving money, it's redirecting firepower.
Precisely. So before we close, let's leave the listener with this thought. Consider the competitive impact of that capital reallocation.
Yeah, think about it. Lumen is taking $1 billion in annual capital that was going into the highly competitive, lower-margin consumer fiber business.
A business they decided isn't core to their future.
And now that $1 billion is freed up. Potentially completely freed up. So what happens next?
What happens to Lumen's growth trajectory? Their ability to compete against the big cloud players, the other connectivity giants.
If that massive capital stream gets funneled entirely into expanding those high-value enterprise grow products, into aggressively building out that critical AI infrastructure.
That capital shift could genuinely change the entire game board for Lumen over the next 3 to 5 years. It's something to watch very closely.